Today, folks, you need to calm down. I know I thought the crisis was averted yesterday. Don't go watch that video because, whoo, baby, we pumped. We pumped after a major drop to only continue a major drop. Is this a crash? No, I think we're more in a correctional period, but you gotta understand, Nvidia yesterday gained more market value than any stock ever had in history. It was like 300 plus billion to only lose all of it for the most part today. Sorry, Nancy Pelosi, you better have closed out some of those options, man. Tesla's down 7%, Amazon almost 8%. Woo, baby, the index, thank God we focus more on indices to remove some of this insane volatility. And the only thing I've been buying that is green is VNQ. I go into the real estate, I'm green on it. Not enough to mitigate the down period here because I don't own enough of it, but damn, let's get into this because whew, man, it's stir crazy in here. So let's get into it with the stocks that I find most entertaining. We're going to talk about Intel. We're going to talk about Amazon and Apple and Canadian Natural Resources. For those of you I know that are on the Canadian side of the border that love watching this video, hit that like button, subscribe if you're on that path to financial independence to perhaps one day retire early, because Intel is down an insane 17%. This is going to be the headliner a lot of people are going to be pointing out because it's a very popular stock. A lot of people thought it was trading at a wicked discount. I mean, it fell off crazy highs. It's down like 50%. It paid a decent dividend yield, but guess what? The dividend's gone. They're firing a bunch of people. They're late to the game. I mean, this is what these big companies were doing a little while ago, but you know, Intel's finally like, hey, I'm losing a lot of money here. You know, our revenue isn't growing. It's down 1% year over year. Our GAAP earnings suck. What are we going to do? We're going to suspend the dividend. You know, we're going to implement a comprehensive reduction spending plan, including more than a 15% headcount reduction. Whew, baby. I don't care for Intel. It's not a stock that excites me. A lot of people thought it was a discount buy. I think they're feeling a lot of pain today. Sorry to hear if you were one of those people buying it, but that's the reality of the markets. Whereas Amazon, on the other hand, you gotta zoom out a little bit. When it comes to these Mag 7-like stocks, we're talking about these historic runs where they just couldn't be stopped. I mean, Amazon ran 102%. I think what we're seeing here is a breathing period, a pretty intense breathing period. I mean, these downtrends are crazy considering the earnings just really weren't that bad. Now, Amazon's always had this problem where they can't actualize a lot of earnings. It's all coming from AWS because obviously we've talked about this. The revenue that they make on selling products isn't actually their revenue. It's just the transactions that are dealt with on their platform that they probably take the smallest commission, which they're probably still losing money on. They are losing money on, but you take a look at the growth here and there's still no signs of stopping the insanity of e-commerce. Now, again, I want to iterate that we're seeing a new trend across many of these companies, and it is a slowdown from the growth we've been seeing quarter over quarter, right? We're starting to nominalize a bit here because I think the total revenue growth was only 10%. Which we'll take a look at past revenue in a second here. But if you take a look here, still insane, right? Like net sales for North America went from 82 billion to 90 billion year over year. International, 29 billion to 31 billion. AWS from 22 billion to 26 billion. I mean, net sales, 147 billion. Net income at 13 billion. These are still incredible numbers. These are still great net income numbers. It's just, like I said, things have gotten so overheated in this market thanks to AI and all this other stuff that, you know, you go on these wicked runs and you're going to get some pretty wicked correctional periods. This is not a crash, though. I'm not concerned to the extent a lot of YouTubers are, you know, predicting something crazy here. I'm going to been buying stocks pretty aggressively. I'm looking to hopefully pick some more up. Might buy some more tomorrow, actually, maybe some S&P. I'm accused or even potentially getting attractive here the way things are dropping. But look, I mean, last quarter here, the year-over-year revenue growth was at like 12%, and now we're down to 10%. So we're starting to see a cyclical leveling off period. And Apple, again, you know, being a company that is highly affected by the interest rates and people spending and turning over products, is actually starting to rally a little bit here. I mean, are we getting into the green? Now we're flat, maybe 1%. Could do what Microsoft did. You know, like we could see a decline period followed by a bit of a recovery because the earnings came in kind of at expectations. Apple's become this boring stock, right? It's kind of lost the oomph and attention that I believe it once had. I feel like Tesla, some other companies have that kind of attention and that excitement, but Apple's definitely lost it in my opinion. You know, their products just aren't what they used to be. I mean, then the last real great product was the Apple Watch. I think that's going to be Tim Cook's legacy, but still, we're taking a look at net sales here that went from 81 billion to 85 billion. We're still kind of in this lull phase where the growth is just not that exciting, right? I mean, gross margin, they've been able to squeeze out some more gross margin, which is great to see. But as we scroll down, let's just take a look because, like I said, EPS came in. These are great numbers for earnings per share. Company buys back a lot of stock. So, I mean, they're doing everything they can to keep the earnings up. If we take a look at iPhone sales, they are still down materially year over year. There's nothing going on here that's exciting. Macs have actually increased marginally, maybe 150 million, which sounds like a lot of money, but for a company like Apple is just not that exciting. iPad sales actually inclined quite a little bit. That's good to see, but again, it's nothing near close to the iPhone numbers, so these things would have to be up materially huge to even make an impact. Wearables, so this would probably be Vision Pro and all this stuff, not really driving enough wearable sales from 8.2 billion to 8, still down. Overall, services are continuing to grow, which is the fastest growing sector for them right now. So again, very boring, nothing exciting. We need lower interest rates. We need a more poppin' economy here, I think, to really get Apple's revenue back up and get some excitement. But this is a fairly long-winded period of virtually no real growth. So it's kind of insane that this is where we're sitting in this market environment, which again doesn't deserve a huge correctional period. But when Apple's trading at a 33, 40 times multiple, it's just not deserved. If we go take a look, and actually let's just take a look at their price ratios here. If we take a look at their PE, this is historically high for them, like insanely high for that matter. Same with Microsoft. We talk about this. So we need a good little correctional period. But if we shift to the Canadian markets, where I don't think we need a correctional period, these companies actually should deserve to grow at some extent. I mean, I'm really excited for Canadian banks and all the Canadian earnings, but Canadian Natural Resources, with its wicked 4.33% yield, posted some numbers here. We'll pull up real quick, and these numbers were good. It looks like they're having a bit of comeback in this market, right? So if we take a look at just the 12-month ending, revenues went from 7.8 to 9 billion, which is a pretty big jump, man. Net earnings from 1.46 to 1.71. It's 80 cents on the bottom line from 67 cents. I'm really surprised the stock didn't pop off more. What I'm really taking in from these earnings in total is that things are fairly nominal. We're back to a more normal environment for growth for big companies, unlike we've seen in the past, because we did go through a slowing period with the interest rate environment. And I think the next growth phase is going to be interest rate cuts, and the market is starting to price it in with some companies. Maybe the real estate market, that could be some potential there. But with this correction, I am definitely looking at potentially getting my continued tech exposure through the S&P, but of course the Qs, especially triple leverage Qs like TQQQ, start becoming more attractive here. I'm not sure if I'm going to start picking this up anytime soon just yet. But man, when you see this kind of correction in the Qs, if you're big into tech, you want that growth, this is exciting times, man. The discounts, very excited for some more earnings to come down the road. Meta's holding the market up a bit. Like I said, eventually these are going to get picked up, these discounts. So let's see how low we go, baby. I'd love to know what you think in that comment section below.